Okay, in this scenario, we meet someone who's got a couple of choices. In fact, there's a bit of choice and there's a bit of uncertainty, which may make this question feel more complicated than the underlying calculations are. So we've got uncertainty over when the bonus is going to be received. So that 160,000 euros may come in this year, may come in next year, and that could make a big difference because next year there is a change in the tax rules, and we'll see how that flows through with respect to the tax deferred accounts. I'll come back to that in a moment. There's also a choice as to whether to invest for 15 years or whether to invest for 65 years. And there's also a choice as to whether to use a tax exempt account or a tax deferred account. So there's a lot going on. It feels like there's a lot of moving parts. So if that got in the way of your understanding, then just focus on making sure the individual calculations do make sense to you. Okay, so what we've got on the next screen is just a summary of the two plans, if you like. So plan A, 15 years investment, and then withdraw the funds while still working. And while still working, Chase will be a high rate taxpayer. Or plan B, use it as a retirement investment, withdraw the funds when a lower rate taxpayer. And the uncertainty has been built into this. So plan A is let's do this year, and plan B is delay until next year. And obviously that would make sense if the bonus is actually received next year. Okay, so we've got our examples, and this is going to pop up on the next screen, but let me just explain something in terms of your tax exempt account and your tax deferred account. So with your tax exempt account, you invest your money net, which means it has been taxed. So the easiest way of thinking about the calculations here is that 160,000 is not actually 160,000, it's a taxed version of 160,000, so it's whatever's left after the tax on ordinary income has been paid. Then in both cases, the returns will be tax-free. In the tax exempt account, the withdrawal at the end will be gross, i.e. no tax. So you're taxed on the way in, you're not taxed on the way out. With the tax deferred account, the investment can be gross. And I just think that is an easier language to use than there is a tax deduction available. I mean, that may be how it's described in certain jurisdictions, but in my mind, just go, well, that 160,000, you basically get the whole lot. You don't suffer tax. And it works its way through tax returns and things like that, but you basically get the tax back. So the full 160,000 can go in. The growth in the fund is tax-free, but the withdrawal will be taxed. Or there will certainly be rules on what happens when you take your money out at the end. So it will be taxed. But if that is on retirement, then the tax rate would be lower, of course. And that's essentially what this is sort of getting down to, is when do you pay your tax? Because the growth in both scenarios is going to be the same factor. And if you just take a simple case where you're a higher rate taxpayer at both ends, then whether you're taxed on the way in or taxed on the way out, actually it comes to the same thing. If there's a difference in tax rates, then it will make a difference to the net outcomes. Okay, so that's what we've got in this exhibit at the moment. Your tax deferred accounts allow you to invest the full amount gross. Tax exempt accounts allow you to invest